everyone, welcome to another edition of the Investing Pantheon, where we deep dive into the major macro trends. Just as the ancient Pantheon stands as a sanctuary for all gods, our Investing Pantheon embraces comprehensive topics in investing across asset classes and styles. We start this presentation with a new era of US debt, which is standing at record high level of 120% of GDP. US this time is entering the rate cut cycle with a very different macros, which is very high debt levels, high inflation. This is creating a structural problem in US of whether or not US can beautifully deleverage. Just by the way, beautiful deleveraging is a concept introduced by Ray Dalio, where he says that certain economies can actually delever without having very recessionary trends come in the economy, and it seems like US is gearing for it, because once we look at the US data, it is looking very strong. So on certain fronts, the US earnings season is on right now, and the corporate profits of US are moving rather from strength to strength. The big banks' results in US has beaten all street estimates. Regardless to say, it is important to have a stable US allocation in our foreign equity portfolios. But circling back to the rest of the world, we do see that the global growth is slowing, and therefore it is the central banks globally that have started to cut rate. One interesting dichotomy here is that it is the developed market central banks which have started to give rate cuts already, whereas the emerging market central banks, speaking of India, Indonesia, are still holding on to rate cuts. Our sense is that these rate cuts will have to come to cushion the economies as the global growth actually starts to slow. So we've all known that the big elephant in the room these days is the geopolitics, be it China-Taiwan, be it the Middle Eastern conflict, or be it the Russian-Ukraine war still continues. Now, within the Middle Eastern space, the news flow is fast changing, with attacks on both sides continuing, and one asset class which is most sensitive to this combat is crude oil. There's a strait called Strait of Hormuz, is very close to Iran, and 25% of all global oil supply passes through the Strait of Hormuz. Now, for some reason, if this was blocked by Iran, I think the oil prices could shoot up dramatically. But until this happens, there are three reasons why oil prices have stayed under control. One is the weak Chinese demand. Second is the higher US production. And third is OPEC informally accepting lower rates as their target rate. But this crude price sensitivity alone is stopping the emerging markets globally to cut on rate, because their inflation is very sensitive to the US price globally. Circling back to US, which we highlighted, is seeing very strong global earnings. The corporate profits are moving from strength to strength. Even economy-wise, US is doing exceptionally well. If we look at the unemployment data, the jobless claims, all of this data is improving. The SAM rule, which became very popular once, is back in the comfort zone. Therefore, US looks to be very promising, and it's abating any signs of recession that was previously expected, especially from inversion of yield curves, etc. So I think in that sense, Fed's rate cut has been delivered right, and it is able to cushion their economy. It is up to the emerging markets now to cushion our own growth. But just, not everything is always hunky-dory when we look at global economy. So I do want to take a moment to highlight here that US manufacturing PMI still is in contraction, whereas services PMI is doing very well. And secondly, because US is a very consumption-based economy, it believes a lot on debt. Finally, the wages or hourly wages are falling a little. At the same time, the future retail sales are expected to fall, and the credit card delinquency rates is going up. So I think the combination of these three factors is a bit of a red alert on US consumption. It is not something that is to be worried about a lot, because US consumption has been very strong off late, so it could just be a correction from very high numbers, but we remain cognizant of it. But overall, it seems like US economy is putting the hard landers behind, and it is rather settling for the soft landing, and maybe, only time will tell. But if I were to look back today, I think Fed has done a good job in saving the economy from recession. At the same time, when we look at India, I think India's high frequency data is also slowing now. So our GST collections have fallen to about 1.7 trillion. At the same time, our PMIs, while we are still in the expansionary zone, they are starting to tip down both on manufacturing as well as in services. The two-wheeler data or the two-wheeler demand as well as the passenger vehicle demand, which is one big proxy of consumer discretionary consumption in the country, have also started to fall now. So there is a feeling of discretionary consumption falling in India as we look at the high frequency data. We see the similar kind of trend when we look at 8 core production data, when we look at railway freight traffic, or when we look at airline passenger growth. So there is a bit of slowdown in growth. FY25 we expected to grow at 7.2%. I think it's a very handsome number to grow at. India will remain the fastest growing economy in the world. But the question is, how will we able to sustain this growth rate, and how well will we do in years to come? In that sense, we need to realize that fiscal and monetary policy coordination is important. All right, so there has been a phase when we think of like 2000 to 2005, when fiscal consolidation was happening but the rates were falling. So it is the monetary policy that stepped up. Reaching up to the great financial crisis, we had the fiscal support, but we had increasing rates, and thereafter we moved towards fiscal consolidation and falling rates. And then just before COVID, we had fiscal support, but the rates were relatively on the downside, easing. COVID hit, we needed fiscal help as well as a fall in rates, and I think that was a time when fiscal policy also fired and monetary policy also fired, which was exceptionally good for the economy and which was the need of the economy, because you were living in an era when growth had taken a 20% hit, and that's unprecedented for the world in general. So I think fiscal and monetary both stepped up, and now we are living, we're just in the regime when fiscal will have to consolidate. There is no way that fiscal can sustain at 4.9%. We have already soft committed for 4.5% by FY26, which by the way is just 1 year apart. And going by the FRBM's target, India will have to roll back on its fiscal deficit. So at a time that fiscal has to tighten, it is the monetary policy that will have to step up to support growth. I think India will still need that support, and the falling growth, the controlled inflation, and global developed market banks cutting rates, all three of them are giving India to have monetary reflation come into the economy. The reason I call it a monetary reflation is that India has had very tight monetary policy so far. So, there was a time when India's, let's say between 2001 and 8, when India's M3, the money supply, would grow at about 17%, and like last decade, we have only grown about 10% in terms of M3. So I think that creation of money at the ground level in India has not happened. And it is needed that India has that monetary reflation, that, our liquidity remains in surplus. The real rates of India are as high as, 2% today, I think, and it has been sticky. It has been higher or at 2%. But to help growth here on, I think India should be comfortable with rates slightly under 2% also. I think that is what will cushion India's growth, and it will provide the next level. So the big takeaway here being, as fiscal policy rolls back, it is the monetary policy that should step up. Of course, India's relatively valuations wise, equity is slightly unfavorable, and that is what we see if we look at India's gold to equity ratio, or if we look at the BEAR ratio, which is bond yields and earnings ratio. all of them are pointing towards slightly higher equity valuations. But as we said, there are pockets of opportunity and we expect investors to come in the large caps. Secondly, we've always been bullish on the defenses, which is pharma, IT, and FMCG, and we also think there is a case to be overweight on the private banks. DII flows have helped the Indian markets when FIIs have been very volatile. October, particularly, has been a month where FIIs have, withdrawn up to 8 billion from the Indian equities. It is one of the highest records. We take a look at where the money has gone in Asia in October, and it seems like Japan is the biggest beneficiary. A big disclaimer here that Chinese numbers are not available real time, so we don't know how much has gone in there, but definitely India has lost about 7.6 billion inflows in October itself. Now the big question these days is that, is India losing to China? Our sense is it's hard to tell. Usually the emerging markets as a basket tend to do well when Fed cuts rate and dollar eases. Right now, there are two more moving factors to it. One is the geopolitics, which makes dollar attractive as a safety haven in a sense. So Fed has cut rate, but dollar has not really eased. And secondly, US is doing very well, as we highlighted before, whether it's by profits pool or company level data or even economy level data, and I think that has led to strength in dollar index. But the big moving part is the US elections, which will be ticking in the first week of November, and which could further change how these macro dynamics move. So we will obviously have our eyes on that one big macro event. From there, let's shift gears to our immediate neighbor, China. We've had a positive China call, which was a tactical call. Let's take a moment to go back and see what really went wrong in China, okay? So to start with, most Chinese households held residential property and the prices of those tumbled. Similarly, most of them had equity portfolios. About 65% allocation was pure equity, and again the equity markets offered negative returns. So there was a sudden collapse of people's net worths in China, which resulted in falling consumption, falling investment. It's just created a vicious circle where a lot has to be done to revive the economy. But be mindful that China has a potential to rebound. It has had a history of rebound, and in the years that it rebounds, it gives the equities give a very outsized return, but because it tends to attract flows into the Chinese and the Hang Seng index as well, and the risk premium starts to ease. So this is the stage that we are playing on. But I say this again, that China has seen a lot of monetary stimulus. It has seen a lot of rate cut. In fact, another 25 basis of rate cut was given just very recently. But I think China will need fiscal stimulus to revive itself. And I think Chinese government have a lot of space available to offer that fiscal stimulus as well. So any news of fiscal help coming towards China will drive the next leg of equity performance, while the monetary stimulus continues to be reassuring for them. But overall, we think there is still some space left in this Chinese rally, and we continue to watch this space closely. Finally, I think let me just sum up saying what is it that we want to say and what are the key macro themes that we are watching. One is that global growth is slowing. We are seeing in our decelerating global PMI. We are seeing why majority of the central banks are now stepping up to cut rates. However, US on the other side is landing softly. It has put the myths of hard landing behind. And the economic data as well as the markets and earnings data in US is looking relatively strong. On the Indian front, the growth numbers, the demand, the on-ground demand is slowing down a little, but the inflation is pretty much under control. India's fiscal position will have to tighten as per the FRBM guidelines, and therefore to cushion growth forward, some monetary help would be needed. We need a monetary reflation where our M3 growth resumes to be slightly higher than the nominal GDP growth, and we definitely can do with a real rate which is sub 2% on the margin. Finally, on China, there is green shoots. We've highlighted them before. The equity performance will depend on certain fiscal stimulus to come in, and if those were to be delivered, which is our base case, equity could see more upside here on. Overall, when we look at the globe today, sitting in our comfortable desk and chair, I think it looks like it continues to be a risk of asset allocation time. So within equities, choose defensives, choose large caps. Separate from defensives, one could also look at being overweight on private banks. Within bonds, choose long duration bonds, choose gold. And in fact, in precious metal, it is the silver as well, which has a lot of space available and could outperform even gold from here on. So it is a global wait and watch scenario that we are sitting at. I think equity markets are right now, and every bad news is being sold to an extreme, but I think that's the nature and the joy of investing. The economic cycle is clearly changing here on. We are moving from high growth, high inflation, high rates to lower growth, lower inflation, and possibly lower rates, and China is making a comeback. So I think a very interesting time to stay in the investing space. Keep watching the global macros. And this, what you saw just now, is just a snippet of our investing Pantheon. I would request you to read the full report, which is available across our LinkedIn and Twitter handles, and we'd love to engage with you on that. Happy investing, and thank you for listening.